You know what keeps me up at night? It's not the stock market, it's not inflation. It's watching good, hard-working Americans hand over more of their Social Security check to Uncle Sam than they ever needed to, simply because nobody ever sat them down and explained how this tax actually works. Here's the reality. Right now, up to 85% of your Social Security benefits can be taxable. Let me say that again. 85%. You paid into this system your entire working life, and now the IRS wants to tax you on money you already paid taxes on. It's legal theft. But here's what most people don't realize. Whether you pay tax on 0%, 50%, or that full 85% isn't random. It's a formula. And if you understand that formula, you can potentially keep thousands of dollars in your pocket every single year. I've talked to retirees who are living on $3,000 a month, and they're paying taxes they could completely avoid with one simple adjustment to how they withdraw from their accounts. I've seen couples lose $500, $800, even $1,200 every month because their financial advisor never explained the provisional income calculation. That's not retirement planning, that's retirement malpractice. The government isn't going to call you and say, hey, you're doing this wrong. They'll just keep cashing your checks. So, let's get into the nuts and bolts of how Social Security taxation actually works, because this is where most people's eyes glaze over and they just accept whatever happens on their tax return. But listen, if you're willing to spend 15 minutes understanding this, you could save yourself 5 figures over the course of your retirement. That's worth paying attention to. Here's the deal. Social Security benefits are taxed based on something called your combined income, or what the IRS calls your provisional income. Now, they don't make this easy to understand, and I'm convinced that's on purpose. The government benefits when you don't know the rules, but your provisional income is calculated by taking your adjusted gross income, adding in any tax-exempt interest you're earning, and then adding in half of your Social Security benefits. That total number determines how much of your Social Security gets taxed. Now here's where it gets interesting. If you're single and your combined income is below $25,000, you pay 0 taxes on your Social Security, nothing. If you're married filing jointly and your combined income is below $32,000, same thing, 0 taxes. But once you cross those thresholds, things change fast. For single filers, between $25,000 and $34,000, up to 50% of your benefits become taxable. For married couples, that ranges $32,000 to $44,000. And if you're above $34,000 as a single person or $44,000 as a married couple, congratulations. Up to 85% of your Social Security is now taxable income. Let me give you a real example, because numbers on paper don't mean much until you see how they actually affect real people. I talked to a couple last year, Bill and Susan. They're both retired, collecting Social Security, and Bill has a pension of about $30,000 a year. Susan also has an IRA that she's taking required minimum distributions from, and those distributions are about $18,000 annually. Their combined Social Security benefit is around $40,000. Now, when you add up their pension, their IRA distributions, and half of their Social Security, their provisional income comes out to about $68,000. That puts them well above that $44,000 threshold, which means 85% of their $40,000 in Social Security benefits, that's $34,000, is getting added to their taxable income. They're paying federal taxes on money they already paid into the system for 40 years. But here's what kills me. Nobody ever told Bill and Susan that the order in which they take their retirement income matters. See, they started taking Social Security at 62 because they thought they needed the money. And they're taking those IRA distributions because they have to. It's a required minimum distribution. But if they had worked with someone who actually understood this stuff, they could have delayed Social Security until 70, lived off the IRA money in their 60s, and dramatically reduced the amount of their Social Security that would eventually be taxable. By delaying Social Security, their benefit would have grown by 8% every year. And by spending down that IRA early, they could have reduced their future required minimum distributions. That strategy alone could have saved them $2,000 to $3,000 a year in taxes over a 20 or 30-year retirement. That's real money. And this is just one strategy. There are so many ways to be smart about this, but you've got to understand the game being played. Let's talk about Roth conversions, because this is one of the most powerful tools available and almost nobody uses it correctly. A Roth IRA is funded with after-tax dollars, which means when you take money out in retirement, it's completely tax-free. And here's the kicker. Distributions from a Roth IRA don't count toward your provisional income calculation. That means they don't affect whether your Social Security gets taxed. So imagine you're 60 years old, you've retired early, and you're living off savings while you wait to claim Social Security at age 70. During those 10 years, you've got a window where your income is relatively low. This is the perfect time to start converting chunks of your traditional IRA into a Roth IRA. Yes, you'll pay taxes on the conversion in the year you do it, but you're paying taxes at a time when your income is low and your tax bracket is lower. Then, when you're 70, 75, 80 years old and taking money out of that Roth, it doesn't increase your provisional income, which means more of your Social Security stays untaxed. This is the kind of forward-thinking planning that separates people who are just getting by in retirement from people who are actually thriving. Let me tell you about another couple, James and Linda. They came to see me a few years back, and James had about $400,000 in a traditional IRA. They were both 63, still working part-time, and planning to fully retire at 65. I told them, look, you've got a 2-year window here where you're still earning some income, but not a ton. Let's start converting $30,000 to $40,000 a year from that traditional IRA into a WTH. They pushed back at first because they didn't want to pay the taxes, but I showed them the math. By converting $75,000 over those 2 years and paying about $12,000 in taxes, they were setting themselves up to pull $75,000 tax-free out of that Roth later in retirement. More importantly, they were reducing the size of their traditional IRA, which meant their required minimum distributions at age 73 would be smaller, which meant less of their Social Security would be taxed. They're now 68, and they thank me every time I see them, because their tax bill in retirement is half of what their neighbors are paying. Now, let's talk about required minimum distributions, because this is where a lot of retirees get blindsided. Once you turn 73, the IRS forces you to start taking money out of your traditional IAS and 401ks, whether you need it or not. And those distributions count as ordinary income, which means they're going to push up your provisional income and cause more of your Social Security to be taxed. A lot of people hit 73, and suddenly their tax bill doubles and they have no idea why. It's because they didn't plan for this. The smart move is to start pulling money out of those tax-deferred accounts before you're required to. If you retire at 65 and don't need the money, pull it out anyway and put it in a taxable brokerage account or convert it to a Roth. Pay the taxes now while you're in a lower bracket and before Social Security enters the picture, because once you're 73 and taking required minimum distributions and collecting Social Security, you're getting hit from both sides, and there's not much you can do about it at that point. There's also something called a Qualified Charitable Distribution, or QCD. And if you're charitably inclined, this is a gift from the tax code. Once you're 70 and a half, you can take up to $105,000 per year directly from your IRA and send it straight to a qualified charity. That distribution counts toward your required minimum distribution, but it doesn't count as income. It doesn't show up on your tax return at all, which means it doesn't affect your provisional income, which means it doesn't cause more of your Social Security to be taxed. If you're already giving money to your church or to charitable organizations, doing it through a QCD is a no-brainer. I met a retired teacher named Margaret who was giving $5,000 a year to her church. She was taking the money out of her IRA, paying taxes on it, and then writing a check to the church. I told her, "Margaret, stop doing that. Do a qualified charitable distribution instead." Now, that $5,000 goes straight from her IRA to the church. She gets credit for her required minimum distribution, and she doesn't pay a dime in taxes on it. She's saving about $200 a year just by changing the mechanics of how she gives. That's wisdom. That's being a good steward of what you've been given. Let's also talk about state taxes, because not all states treat Social Security the same way. There are 38 states that don't tax Social Security benefits at all. States like Florida, Texas, Nevada, Washington, they're not touching your Social Security. But then you've got states like Minnesota, Vermont, and Connecticut that will tax your benefits if your income is above certain thresholds. If you're on the border of retiring and you have flexibility about where you live, this is something to consider. Moving from a state that taxes Social Security to one that doesn't could save you thousands of dollars every year. I'm not saying you should uproot your entire life just to save on taxes, but if you're already thinking about relocating to be near family or to enjoy better weather, the tax implications should be part of that conversation. And here's something most people don't think about: timing. When you claim Social Security can have huge tax implications beyond just the size of your benefit. If you claim at 62, you're locking in a smaller benefit, but you're also starting the clock on provisional income calculations earlier. If you wait until 70, your benefit is 77% larger than it would have been at 62, and you've given yourself 8 more years to do Roth conversions, spend down IAS, and manage your taxable income. For a lot of people, especially those with substantial retirement savings, delaying Social Security is one of the best tax moves they can make. I also want to talk about working in retirement, because a lot of people don't realize how this affects their Social Security taxes. If you're under your full retirement age and you're collecting Social Security while also working, there's an earnings limit. In 2025, if you earn more than $23,400, Social Security will withhold $1 for every $2 you earn above that limit. Now, you're not losing that money forever. It gets added back into your benefit calculation later, but in the short term, it can create a real cash flow problem. More importantly, if you're working and earning a decent income, you're almost certainly going to be in a situation where 85% of your Social Security is taxable because your provisional income is going to be high. For a lot of people, it makes more sense to delay claiming Social Security if they're going to keep working anyway. There's also the strategy of filing and suspending, or more accurately now, just understanding spousal benefits. If you're married, the lower earning spouse can sometimes claim a spousal benefit based on the higher earner's record. This gets complicated, but the point is that married couples have options that single people don't. And those options can be used to minimize taxes. For example, if one spouse delays Social Security to age 70 while the other claims earlier, you're getting some income now while maximizing the survivor benefit later, and you're managing the household's provisional income in a way that might keep you under those tax thresholds. Here's the bottom line, and I want you to really hear this. The government has set up a system where they're going to take as much of your Social Security in taxes as you let them. But you have control here. You have options. The decisions you make in your 50s and 60s about when to claim Social Security, how to withdraw from your retirement accounts, whether to do Roth conversions, where to live, all of these decisions have tax consequences that will follow you for the rest of your life. And the tragedy is that most people make these decisions without understanding the full picture. They claim Social Security as soon as they're eligible because they're afraid the system is going to collapse. They take money out of their IAS without thinking about the tax impact. They don't do Roth conversions because they don't want to pay taxes today, not realizing they're setting themselves up to pay way more in taxes tomorrow. This isn't complicated stuff, but it does require you to think ahead and to get good advice. And I mean real advice, not just someone selling you an annuity or trying to manage your investments. You need someone who understands the tax code and who can help you build a withdrawal strategy that makes sense for your situation. Because at the end of the day, it's not about how much money you have, it's about how much of that money you get to keep. And every dollar you save in taxes is a dollar you can spend on your grandkids, on travel, on giving, or on whatever brings you joy in this season of life. Don't leave that money on the table just because you didn't take the time to understand how the system works.